Item 2. Management's discussion and analysis of financial condition and results of operations. We founded DOMO in 2010 with the vision of digitally connecting everyone within the enterprise with real-time, rich, relevant data, and then enabling all employees to collaborate and act on that data. We realized that many organizations were unable to access the massive amounts of data that they were collecting in siloed cloud applications and on-premise databases. Furthermore, even for organizations that were capable of accessing their data, the process for doing so was time-consuming, costly, and often resulted in the data being out of date by the time it reached decision makers. The delivery format, including alert functionality, and devices were not adequate for the connected and real-time mobile workforce. Based on these observations, it was apparent that all organizations, regardless of size or industry, were failing to unlock the power of all of their people, data, and systems. To address these challenges, we provide a modern cloud-based AI and data products platform that digitally connects everyone at an organization, from the CEO to frontline employees, with all the people, data, and systems in an organization, giving them access to real-time data and insights and allowing them to build data products that generate measurable value for the business. Business leaders, department heads, and managers are typically initial subscribers to our platform, deploying Domo to solve a business problem or enable departmental access. Over time, as customers recognize the value of our platform, we engage with CIOs and other executives to facilitate broader adoption. We primarily offer our platform, which customers can adopt in whole or in part, as a consumption-based service, which includes consumption-based agreements and enterprise-wide agreements, ELAs, with unlimited users and a data cap. Customers with consumption-based agreements have an annual purchase commitment based on estimated usage, utilizing a tiered pricing structure, which is paid upfront. Historically, we also offered subscription-based agreements, under which subscription fees are based upon the chosen Domo package, which includes tier-based platform capabilities or usage. As of the end of our most recent fiscal quarter, 89% of our annual recurring revenue, ARR, was utilizing the platform as a consumption-based service, and we expect this percentage to increase in future periods. As of April 30th, 2026, 76% of our customers were under multi-year contracts on a dollar-weighted basis, consistent with 76% of customers as of January 31st, 2026. The high percentage revenue from multi-year contracts among both new and existing customers has enhanced the predictability of our subscription revenue, which includes both subscription-based and consumption-based agreements. We typically invoice our customers annually in advance for subscriptions to our platform. Remaining performance obligations, RPO, represents the remaining amount of revenue we expect to recognize from existing non-cancelable contracts, whether billed or unbilled. As of April 30th, 2025 and 2026, total RPO was $427.5 million and $437.3 million, respectively. The amount of RPO expected to be recognized as revenue in the next 12 months was $241.0 million and $239.6 million as of April 30th, 2025 and 2026, respectively. We had total revenue of $80.1 million and $79.4 million for the 3 months ended April 30th, 2025 and 2026, respectively. For the 3 months ended April 30th, 2025 and 2026, no single customer accounted for more than 10% of our total revenue, nor did any single organization when accounting for multiple subsidiaries or divisions which may have been invoiced separately. Revenue from customers with billing addresses in the United States comprised 80% and 79% of our total revenue for the 3 months ended April 30th, 2025 and 2026, respectively. We have incurred significant net losses since our inception, including net losses of $18.1 million and $14.2 million for the 3 months ended April 30th, 2025 and 2026, respectively, and had an accumulated deficit of $1,561.1 million at April 30th, 2026. We expect to incur losses for the foreseeable future and may not be able to achieve or sustain profitability. Impact of macroeconomic conditions. Prevailing macroeconomic conditions have elongated the software sales cycle, increased deal scrutiny, and made renewal discussions more challenging. These conditions may continue to impact our business and those of our customers in a manner that we may not be able to quantify or isolate from other drivers of our performance, and may negatively impact our revenue growth in the near term. Ongoing concerns about the health of the U.S. and global economies may cause certain of our current and potential customers to reduce or delay technology spending or seek payment or other concessions from us. These conditions, along with the ongoing uncertainty in the SaaS sector, may materially and negatively impact our operating results, financial condition, and prospects. In response to these dynamics, we have taken and intend to continue to take steps to better align our sales team and focus on controlling costs, which we expect will result in improved margins and efficient growth in the long term. However, as described below under liquidity and capital resources, conditions exist that raise substantial doubt about our ability to continue as a going concern, and there can be no assurance that these steps will result in sustained positive cash flow. Continue to attract new customers. We believe that our ability to expand our customer base is an important indicator of market penetration, the growth of our business, and future business opportunities. We define a customer at the end of any particular quarter as an entity that generated revenue greater than $2,500 during that quarter. In situations where an organization has multiple subsidiaries or divisions, each entity that is invoiced at a separate billing address is treated as a separate customer. In cases where customers purchase through a reseller, each end customer is counted separately. We define enterprise customers as companies with over $1 billion in revenue, and companies with less than $1 billion in revenue are corporate customers. In order to maintain comparability, companies who become customers with revenue below $1 billion and subsequently exceed that threshold are considered enterprise customers for all periods presented. As of April 30th, 2026, we had over 2,400 customers. Enterprise customers accounted for 45% and 44% of our revenue for the 3 months ended April 30th, 2025 and 2026, respectively. To drive growth among both our enterprise and corporate customers, we intend to further develop our partner ecosystem by establishing agreements with more software resellers, systems integrators, and other partners to provide broader customer and geographic coverage. We believe we are underpenetrated in the overall market and have significant opportunity to expand our customer base over time. Customer upsell and retention. We employ a land, expand, and retain sales model, and our performance depends on our ability to retain customers and expand the use of our platform at existing customers over time. It currently takes multiple years for our customers to fully embrace the power of our platform. We are still in the early stages of expanding within many of our customers. Under consumption-based pricing, our customers have access to all features offered on our platform, which allows for increased discoverability across the entire customer organization. We believe that as customers continue to deploy greater volumes and sources of data from multiple use cases under our consumption-based pricing model, the unique features of our platform can address the needs of everyone within their organization. Our ability to successfully upsell and the impact of cancellations may vary from period to period. The extent of this variability depends on a number of factors, including the size and timing of upsells and cancellations relative to the initial subscriptions. We have invested in platform capabilities and online support resources that allow our customers to expand the use of our platform in a self-guided manner. Our professional services, customer support, and customer success functions also support our sales force by helping customers to successfully deploy our platform and implement additional use cases. In addition, our partner ecosystem has become increasingly important over time. We work closely with our customers to drive increased engagement with our platform by identifying new use cases through our customer success teams as well as in-platform self-guided experiences. We actively engage with our customers to assess whether they are satisfied and fully realizing the benefits of our platform. While these efforts often require a substantial commitment and upfront costs, we believe our investment in product, customer support, customer success, and professional services will create opportunities to expand our customer relationships over time. Our ability to drive growth and generate incremental revenue depends heavily on our ability to retain our customers and increase their usage of our platform. With that objective in mind, we allocate our customer success and customer support resources to align with maximizing the retention and expansion of our subscription revenue. An important metric that we use to evaluate our performance in retaining customers is gross retention rate. We calculate our gross retention rate by taking the dollar amount of annual contract value, ACV, that renews in a given period, divided by the ACV that was up for renewal in that same period. The ACV of multi-year contracts is also considered in the calculation based on the period in which the annual anniversary of the contract falls. Our trailing 12-month gross retention rate was 85% and 86% as of April 30th, 2025 and 2026, respectively. Our gross retention has been affected in part due to macroeconomic conditions and challenging renewals from customers with COVID-19 use cases of our platform. As we continue to expand our partner ecosystem and develop methods to encourage wider and more strategic adoptions, we expect that customer retention will increase over the long term. Sales and marketing efficiency. We are focused on increasing the efficiency of our sales force and marketing activities by enhancing account targeting, messaging, field sales operations, and sales training in order to accelerate the adoption of our platform. Our sales strategy depends on our ability to continue to attract and retain top talent, to increase our pipeline of business, and to enhance sales productivity. We focus on productivity per quota-carrying sales representative and the time it takes our sales representatives to reach full productivity. We manage our pipeline by sales representative to ensure sufficient coverage of our sales targets. Our ability to manage our sales productivity and pipeline are important factors to the success of our business. We have taken steps to better align our sales and marketing spending and headcount to efficiently grow and attract new customers. Sales and marketing expense as a percentage of total revenue was 50% for the 3 months ended April 30th, 2025, compared to 47% for the 3 months ended April 30th, 2026. Leverage research and development investments for future growth. We plan to continue to make investments in areas of our business to continue to expand our platform functionality. This may include investing in machine learning algorithms, predictive analytics, and other artificial intelligence technologies to create alerts, detect anomalies, optimize queries, and suggest areas of interest to help people focus on what matters most. These investments may also include extending the functionality and effectiveness of our platform through improvements to the DOMO App Store and developer toolkits, which enable customers and partners to quickly build and deploy custom data applications. The amount of new investments as a percentage of revenue required to achieve our plans is expected to increase slightly in the near term, then remain consistent in the long term. Research and development expense as a percentage of total revenue was 25% for the 3 months ended April 30th, 2025, compared to 23% for the 3 months ended April 30th, 2026. Billings represent our total revenue plus the change in deferred revenue in a period. Billings reflect sales to new customers plus subscription renewals and upsells to existing customers, and represent amounts invoiced for subscription, support, and professional services. We typically invoice our customers annually in advance for subscriptions to our platform. Because we generate most of our revenue from customers who are invoiced on an annual basis and have a wide range of annual contract values, we may experience variability due to typical enterprise buying patterns and timing of large initial contracts, renewals, and upsells. Discussion of the 3 months ended April 30th, 2025 and 2026. The decrease in subscription revenue was primarily due to a $2.6 million increase from new customers, partially offset by a $4.2 million net decrease from existing customers. Our total customer count decreased 6% from April 30th, 2025 to April 30th, 2026. For the purposes of this comparison, new customers are defined as those added since the end of the prior year quarter, and revenue from existing customers is presented net of churn. The increase in professional services and other revenue was primarily due to a $0.7 million increase in event sponsorships and minor increases in other revenue. Cost of revenue, gross profit, and gross margin. The increase in cost of professional services and other revenue is primarily due to a $1.1 million increase in employee-related costs, partially offset by a $0.8 million decrease in outsourced services. Subscription gross margin decreased slightly, primarily due to a decrease in subscription revenue. As we continue to shift more of our customer base to consumption-based pricing, we expect subscription gross margin to remain relatively stable in the near term and increase in the long term. Services gross margin increased primarily due to a favorable mix of higher margin projects delivered during the current period and a decrease in outsourced services. We expect the gross margin for professional services to fluctuate from period to period due to changes in the proportion of services provided by third-party consultants, seasonality, and timing of projects with differing margins. The decrease in sales and marketing expenses was primarily due to a $5.2 million decrease in commission expense, partially offset by a $3.5 million increase in employee-related costs. These offsets are partially driven by certain fiscal 2026 commissions paid out the form of fully vested restricted stock units, RSUs, instead of cash. Sales and marketing expense as a percentage of total revenue decreased from 50% in the 3 months ended April 30th, 2025, to 47% in the 3 months ended April 30th, 2026. We expect sales and marketing expense as a percentage of revenue to be relatively stable in the near term and decrease in the long term. Research and development expenses decreased primarily due to a $2.0 million decrease in employee-related costs, driven by stock-based compensation. This was partially offset by a $0.7 million decrease in capitalized software, which increases expense. Research and development expense as a percentage of revenue decreased from 25% in the 3 months ended April 30th, 2025, to 23% in the 3 months ended April 30th, 2026. We expect research and development expense as a percentage of revenue to decrease in the long term. General and administrative expenses decreased due in part to a $0.4 million decrease in travel expense and a $0.3 million decrease in income tax expense. General and administrative expenses as a percent of revenue changed from 17% in the 3 months ended April 30th, 2025, to 18% in the 3 months ended April 30th, 2026. We expect general and administrative expense as a percentage of revenue to decrease in the long term. Remeasurement of warrant liability resulted in a $2.1 million gain during the 3 months ended April 30th, 2026, a favorable change of $0.9 million. Other expense net increased primarily due to minor increases in interest expense and expense related to changes in foreign exchange rates and higher balances of cash denominated in currencies other than the functional currency, and minor decreases to interest income. We expect interest expense to increase modestly in the near term due to an increasing principal balance. We expect foreign currency gains and losses could become more pronounced due to current market volatility. Income taxes increased primarily due to higher taxable income from our international subsidiaries during the 3 months ended April 30th, 2026. Liquidity and capital resources. As of April 30th, 2026, we had $39.1 million of cash and cash equivalents, which were held for working capital purposes. Our cash and cash equivalents consist primarily of cash and money market funds. We have a $125.3 million credit facility, all of which had been drawn as of April 30th, 2026. Since inception, we have financed operations primarily from cash collected from customers for our subscriptions and services, periodic sales of convertible preferred stock, our initial public offering, and to a lesser extent, debt financing. Our principal uses of cash have consisted of employee-related costs, marketing programs and events, payments related to hosting our cloud-based platform, and purchases of short-term investments. As of April 30th, 2026, we were not in compliance with the minimum annualized recurring revenue covenant under our credit facility. As a result, the lenders have the right to accelerate repayment of the $136.6 million of principal and related fees, and we have classified the related term loan and fees as a current liability as of April 30th, 2026. Our cash and cash equivalents of $39.1 million as of April 30th, 2026 would not be sufficient to repay the term loan upon any such acceleration. As a result, substantial doubt exists about our ability to continue as a going concern. In connection with the covenant noncompliance described above, the company entered into a forbearance agreement with its lenders, under which the lenders agreed to forbear from exercising their rights and remedies with respect to the noncompliance and certain other specified and anticipated defaults during a limited forbearance period, subject to certain conditions. The forbearance does not waive the underlying default and does not change the classification of the term loan, which remains a current liability, and upon its expiration, the lenders may exercise their rights and remedies, including acceleration. The forbearance period is contingent on the company's pursuit and completion of a potential transaction, including the company's entry into a definitive purchase agreement by July 31st, 2026, and the completion of a transaction no later than November 30th, 2026. The company is in advanced negotiations regarding a potential transaction. While substantial progress has been made, no definitive agreement has been executed, and there can be no assurance that any transaction will result from these discussions. If negotiations continue to progress successfully, the company anticipates that a potential transaction could be announced in the near term. Management's plans to mitigate the conditions described above are focused on completing this potential transaction. The company also has access to an at-the-market equity offering program under which it may sell up to $150.0 million of its Class B common stock. The completion of a potential transaction and the company's ability to raise capital under the at-the-market program depend on factors outside the company's control, including the actions of the company's lenders, potential counterparties, and investors, as well as market conditions, and there can be no assurance that any of these plans will be entered into or completed on acceptable terms or at all. Accordingly, management has concluded that these plans do not alleviate the substantial doubt about the company's ability to continue as a going concern. If we are unable to obtain sufficient liquidity, the lenders could accelerate our indebtedness and foreclose on our assets, and our business, financial condition, and ability to continue operations would be materially and adversely affected. On September 6, 2024, we entered into a controlled equity offering sales agreement with Cantor Fitzgerald & Co. Cantor. Pursuant to the sales agreement, we may sell from time to time up to an aggregate of $150.0 million of our Class B common stock through an at-the-market offering defined in Rule 415 under the Securities Act. We will pay Cantor a commission equal to 3.0% of the gross proceeds from the sale of shares of our Class B common stock under the sales agreement. The $150.0 million of Class B common stock that may be offered, issued, and sold under the sales agreement is included in the $300.0 million of securities that may be offered, issued, and sold by us under our registration statement on Form S-3 that was effective on September 20th, 2024. No shares have been sold pursuant to the sales agreement to date. We have a credit facility that permits up to $125.3 million in term loan borrowings, all of which had been drawn as of April 30th, 2026. The credit facility is secured by substantially all of our assets. In February 2024, we entered into an amendment to the credit facility which extended the maturity date for the outstanding loan from April 1st, 2025 to April 1st, 2026, and made certain modifications to the financial covenants. In conjunction with this amendment, we issued 189,036 fully vested warrants to purchase shares of our Class B common stock. In August 2024, we entered into an amendment to the credit facility, which refinanced the existing term loans, extended the maturity date from April 1st, 2026 to August 19th, 2028, revised interest amounts payable in cash and payable in kind, and made certain modifications to the financial covenants. Furthermore, Certain lenders participating in the credit facility were paid in full for their portion of the principal, PIK interest, and amendment fee and were replaced by new lenders who refinanced those amounts. We paid and subsequently refinanced the $7.0 million closing fee associated with the credit facility, resulting in no net impact to our cash balance. Additionally, the $5.0 million amendment fee from the August 2020 amendment plus $2.3 million of accrued PIK interest, totaling $7.3 million, was refinanced as the second PIK amendment fee per the August 2024 amendment. The second PIK amendment fee accrues interest at a rate of 9.5% per year and is due upon maturity, along with the related capitalized interest. Also, in conjunction with this amendment, we issued 1,022,918 fully vested warrants to purchase shares of our Class B common stock. These warrants have an exercise price of 0.01 cent per share and expire on August 19, 2028. The credit facility requires interest-only payments on a portion of the accrued interest until the maturity date. This payable portion of the interest that accrues on the outstanding principal of the term loan is due in cash on a monthly basis, which, as of April 30, 2026, accrued at a floating rate equal to the greater of 1, 8.0% and 2, adjusted term SOFR. Adjusted term SOFR is defined as the greater of A, 2.5% and B, term SOFR. In the event that SOFR is unavailable, interest will accrue at a floating rate equal to the greater of 1, 7.0% and 2, the alternate base rate plus 2.75% per year. The alternate base rate is defined as the greatest of A, the prime rate, B, federal funds effective rate plus 0.5%, and C, adjusted term SOFR plus 1.0%. The federal funds effective rate is defined as the rate published by the Federal Reserve System as the overnight rate, or, if such rate is not so published, the average of the quotations for the day for such transaction received by administrative agent from 3 federal funds brokers. As of April 30, 2026, the cash interest rate was approximately 6.7%. In addition to the 6.7% cash interest rate, a fixed rate equal to 5.0% per year accrues on the outstanding principal of the term loan. This capitalized portion of the interest is added to the principal amount of the outstanding term loan on a monthly basis and is due upon maturity.